Hello friends, welcome to EduCBA's program on financial accounting. This is part 2 of the two-part series, and we had looked at financial accounting from the perspective of giving knowledge to someone who has almost zero knowledge of finance and accounting altogether. So it is appropriate for someone who is from the HR or marketing or sales, or maybe is in the middle management or senior management level, where you want to really apply accounting concepts in your firm and see how they integrate from the analysis standpoint. So from that point of view, this financial accounting course was kind of designed, and this is part 2 of the second two-part series. In the first part, we have discussed what was income statement, what was balance sheets, and what was cash flows. Income statements were nothing but the profitability measures of the company. Balance sheets were nothing but the assets and how they were sourced about the company. Cash flows were about how cash came into the system and went out of the system, a snapshot of that. So we learned all those nitty-gritties and basics of accounting in part 1. So what we will discuss in part 2. Part 2 is about financial statement analysis techniques. Now, individually, when we learned about income statements, balance sheets, and cash flows, we understood that okay, company is doing good from the point of view of profitability. Maybe company is good from the asset standpoint, or maybe company is having good cash flow from operations. But if you have to take an integrated or a balanced approach, you have to analyze this from a total bird's eye view kind of approach. So that's where we look at ratio analysis, and it's divided into different kinds of analysis. The first one is regarding the horizontal analysis and vertical analysis, and you can apply these techniques on both the income statements and the balance sheets. Later we look at something like ratio analysis from the point of view of turnovers. So we look at inventory turnovers, accounts payables turnovers, receivables turnovers, what is cash conversion cycle, why working capital is very important, and we must measure working capital ratios. So these were working capital ratios, and we discussed this in detail. Then we look at what are liquidity ratios. Something like liquidity and solvency ratios would be something like current assets to current liabilities. So current ratios, quick ratios. These are nothing but give you a snapshot of how liquid the firm's assets are. So in case of bankruptcy or in case of cash crunch, whether the company will be able to kind of sell off their assets and meet its obligations. So these are the measures to look at. Profitability ratios now gives nothing but the profits of the company. So profits can be measured at various levels, at the bottom line or the net profit level. Then we also introduce you to the concept of EBIT and EBITDA, that is earnings before interest and taxes, and earnings before interest, taxes, depreciation and amortization for EBITDA, and how can they be interpreted. So that's where we look at all of these. And last but not the least, we also look at how returns can be measured from the point of view of shareholders' equity holders. So we also define what is ROE, that is return on equity. So this is kind of covered in much more detail in financial statement analysis, and the second part actually covers income statements. So obviously income taxes, and why income taxes are important, and why you must analyze income taxes. What if you pay more taxes, then it could lead to deferred tax assets. If you pay less taxes, it may lead to deferred tax liabilities in a very general crude way. So we actually explain you deferred tax assets and liabilities in that context, and that's what about it in this course of part 2 in this course as such. Thank you.